Today, we will look at CP Rail, their ongoing expansion, what this means for investors, and we will begin right now. The prize was Kansas City Southern, and both Canadian National and Canadian Pacific Railways were bidding for this American railroad that would give the winner access to Mexico. CP Rail won this bid and entered into an agreement to buy Kansas City Southern for $31 billion, and they will also take on Kansas City's $3.8 billion in debt. We will talk about debt a little later in the video. The big takeaway on this deal is that it sets up Canadian Pacific with a rail system that has access to Mexico, and this will overall be good for their bottom line. Before we pass go and take a ride on the CP Rail, let me know in the comments if you are invested in any railroad companies. I currently hold CNR, CP, and Union Pacific. Also, a massive thank you for spending some time here today as we make this the home of free financial content. So be sure to subscribe as you do not want to miss a single moment. CP Rail is not as big as CN as they do not have the tracks pushing up into the Canadian north like CNR does. Edmonton is as north as they go. They also do not hit the East Coast as Montreal is their eastern terminus. They do dip into the United States, and the Kansas City deal will take them well into Mexico. Providing rail access to Mexico will be huge for CP Rail, and this should bode well for a long-term investment. However, before we congratulate CP Rail, this deal is not 100% yet. They did pass one big hurdle in mid-August when they received approval for the deal from the U.S. Foreign Investment Committee. This is huge, and that announcement did drive their price up a wee bit. More specifically, 2.8%. Now, they do have one more approval from the U.S. Surface Transportation Board, and this final review should be complete in early 2023. With this approval, CP Rail will officially be the only railroad that connects Canada, the U.S., and Mexico. That, my friends, is a big deal. We are not going to jump too deep into the history of CP, though it is rather cool if you are a Canadian history nerd. I will only say one thing that I did want to share. The CP Rail formed out of a condition for Canadian Confederation. John A. Macdonald, our first Prime Minister, made it a campaign promise all the way back in 1870. They began as a dream to link Eastern and Western Canada, and here we are today about to add Mexico to that link. Holy banana bread, that is just beyond cool. As investors, we of course need to see the numbers. Let's do that. Well, let's do that right now. The market cap for CP is sitting at $98.19 billion. They also have a pretty nice beta sitting at 0.78. This makes them considerably less volatile than the market average. Railroads in general are recession-proof investments, and CP is, well, they're no exception to that. When it comes to valuing the company, we will start with their price to earnings ratio, which comes in at 36.70, which is significantly higher than CNR, who has a price to earnings ratio of 22.60. If we also look at CP's forward PE ratio, we get 26.0, which makes a lot of sense. A PE ratio can get quite inflated in a time of expansion, and that means that CP may not be as overvalued as the higher PE ratio is suggesting. When we look at their price to book ratio, that comes in at 2.80, and that's actually not bad for the rail industry. CNR, for example, has a price to book ratio of 5.20. Now, if we switch over to earnings, these of course are pretty important. We want to know what they're making, and more importantly, we want to know where we can expect those earnings to be going. For CP, their forecasted annual earnings growth has been calculated to be 19.6%. Their overall revenue is expected to grow by 24.5%. These numbers have both come in above the industry averages of 11.7% and 13.3% respectively. These numbers are pretty good, and they will probably change once the Kansas City deal officially closes. Currently, their earnings per share is 2.88, and when we look at their diluted EPS, we get 2.87. This initially looks pretty darn good, though I do have to point out there was some dilution due to some internal sell-offs. Nonetheless, it does look a lot better now. Let's actually look at our returns with CP. We will start with their dividends. Their yield is pretty low as it comes in at 0.72%. That is paid out quarterly in the amount of 19 cents per share. The payout ratio is, well, yeah, it's very low at 26.48%, but this does make sense as they have been, well, yeah, they've been much more focused on growth. In 2021, they began the year with a share price of $87.10, and then they finished the year with their share price being $93.19 for a return on investment of 6.7%. So for 2022, they started at $93.19, and at the time of recording, they have a share price of $105.63 for an ROI of 13.3%. This actually does make sense as they had some dilution, and they also had to deal with a bear market. One example of that dilution I keep talking about is that their VP of operations sold $3.1 million worth of stock. Now that we know the returns, let's look at the debt. Short-term is an issue because their short-term assets come in at $1.61 billion, while their liabilities are priced at $3.21 billion. I do tend to get a little nervous when a company is unable to cover their liabilities. However, with long-term, we get a completely different story with CP. Their long-term assets are valued at $68.26 billion compared to $31.25 billion in liabilities. Those are better numbers that I feel a lot more comfortable with. When we apply some of these numbers and look at their debt to equity ratio, we get 56.2%, which is, it's a little high, but the big story is that it was much higher in the past. CP has been managing their debt very well, and this number has come down. Back in September of 2022, it was up at 127.1%. Yeah, that's a spot that would have made me nervous. CP has no concerns whatsoever about covering the interest on their debt. They are indeed well positioned to take on that additional debt from the buyout of Kansas City Southern. I expect that extra debt will not make a major impact on CP. Okay, so what is the final verdict? CP is a recession-proof investment that is heavier on the growth side and not a good choice if you were looking for dividends. They have experienced some amazing growth, but that is going to temper down in the short term as the Kansas City deal finally completes. Short term, they will have some growth, but their big growth story will come in the future, as they truly have set themselves up for a very bright long-term outlook. This is a perfect stock for a long-term growth strategy. I do have the stock, and it sits nicely in my Wealthsimple RRSP. This is one that I would recommend you break out the due diligence for. The fun does not have to end here because you can always watch my video on Canadian National Railway that I have linked in the top left corner. Or right below that, YouTube will show you a video they think you will like. Your click, of course, will decide who is right, and I will see you in the next video.